For the last decade, a silent war has raged for control of your investments. Legendary Wall Street managers versus the rise of artificial intelligence. On one side, high-fee human experts promising to beat the market. On the other, robo-advisors and algorithms, trading at lightning speed for a fraction of the cost. So who actually won? Today we're cutting through the hype and diving into the real numbers. We'll break down hedge fund returns, robo-advisor performance, and even how AI is tackling crypto volatility. By the end, you'll know whether to trust your money to a human or an algorithm. Let's get to the heart of it. Who performed better over the last decade, humans or machines? The old wisdom said you needed a pricey human manager to beat the market, but the data tells a different story. According to the SPIVA scorecard, 90% of actively managed large-cap funds failed to beat the S&P 500 over the last 10 years, after fees. Meanwhile, robo-advisors tracking low-cost index funds matched or outperformed most human managers, charging a fraction of the fees. The takeaway? For most investors, paying high fees for active management has been a losing game. Algorithms and robo-advisors have quietly delivered better, more reliable results. The era of the expensive stock picker is fading fast. AI isn't just about tracking the market anymore. It's about finding the next big winner before anyone else. Generative AI, like ChatGPT, can now analyze massive data sets, earnings calls, patents, news, and social media in minutes. Imagine asking AI to scan all semiconductor earnings calls, flag companies mentioning AI and data center growth, then cross-check patent filings for real innovation. Next, it runs sentiment analysis on news and social media, spotting shifts before they hit the price. The result? A synthesized report highlighting companies with real momentum and innovation, potentially the next NVIDIA. This level of research was once reserved for elite hedge funds. Now, generative AI is putting these tools in your hands. It's not just about numbers, it's about finding hidden value before the crowd. The future of stock picking is here, and it's powered by AI. Are you ready to use it? Let's see how it works in practice. Let's shift to crypto, the ultimate test of market prediction. I fed a large AI model historical prices, on-chain data, and macro trends to forecast Bitcoin's 2025 scenarios. Base case steady growth post-halving, with a bull run peaking around $120K, $150K, driven by ETF demand and institutional adoption. Bull case Fed rate cuts and regulatory clarity could push Bitcoin to $200K, $250K. Bear case sticky inflation or a regulatory crackdown could send prices back to $40K, $50K. For AI-themed altcoins like Render, the model links growth to AI industry demand, with potential for explosive gains if major partnerships emerge. The takeaway? AI can map out scenarios, but crypto's wild swings mean nothing is guaranteed. Use these insights as a guide, not gospel. Let's get practical. How do you set up a smart, automated portfolio in minutes? Robo-advisors make it easy. Answer a few questions about your goals and risk tolerance, and the platform builds a diversified ETF portfolio for you. For a $10K moderately aggressive portfolio, you might get 90% stocks, 10% bonds, spread across US, international, and emerging markets. The robo-advisor handles all the buying, rebalancing, and even shows you how your portfolio would have performed in past crises. All this takes about 15 minutes and costs a fraction of a traditional advisor. It's a set-it-and-forget-it solution that's outperformed most human managers. The future of investing is automated, accessible, and data-driven. Anyone can start, no Wall Street connections required. Let's see how easy it is to build your own. Investing in AI isn't just about stocks. There's a new wave of crypto tokens powering the decentralized machine economy. Here are 5 to watch. The Graph, GRT, indexes blockchain data for AI models. Think of it as the plumbing for decentralized data. Arweave, AR, offers permanent decentralized storage for valuable AI models and datasets. Akash Network, AKT, a marketplace for renting out unused computing power, challenging the big cloud providers. Render, RNDR, decentralized GPU power for graphics and AI tasks with strong community backing. Bittenser, TO, the most ambitious, building a peer-to-peer network where AI models collaborate and get rewarded. These tokens aren't just speculative, they're the infrastructure for the next era of AI. High risk, high potential. Do your research, but don't ignore the machine economy. The future of AI might be built on blockchain. Which token will lead the way? Imagine owning a piece of a skyscraper for $50. Tokenized real-world assets make it possible. Tokenization turns physical assets like real estate into digital tokens, letting you buy, sell, and trade fractional ownership on the blockchain. Unlike traditional REITs, you can pick specific properties and receive rental income directly to your wallet. Platforms handle the legal and technical work, making real estate investing more accessible than ever. Regulation is the main hurdle, but clear frameworks are emerging in places like Switzerland and Singapore. As compliance grows, expect more institutional money to flow in. Tokenization is democratizing ownership, one building at a time. The future of real estate is digital, liquid, and global. Stablecoins are the backbone of crypto, but not all are created equal, especially under regulatory pressure. We stress-tested the top contenders with a simulated 30% redemption run. USDC, backed by cash and treasuries, is built for transparency and would likely hold its peg. Tether, USDT, is less transparent with riskier reserves. Under stress, its peg could break. Newer bank-backed coins like FDUSD are designed for compliance and would likely perform well. The future? U.S. regulation will demand strict reserve standards. Stablecoins with transparency and high-quality reserves will survive and thrive. The rest face an uncertain fate. Trust, not just tech, will decide the winners. The quantum computer kills Bitcoin panic? Let's set the record straight. Yes, quantum computers could theoretically break Bitcoin's encryption, but we're decades away from that level of power. Today's quantum machines are nowhere near strong enough. Meanwhile, developers are already building quantum-resistant cryptography. The transition will be slow, careful, and well-telegraphed. No sudden doomsday. Watch for real progress in quantum tech and crypto upgrades, not clickbait headlines. The threat is real but manageable. Bitcoin isn't going down without a fight. ESG investing. Can you do good and do well? We used AI to score every S&P 500 company on environmental, social, and governance factors using alternative data like satellite imagery and employee reviews. The AI reweighted the index, favoring high ESG companies. Backtesting showed in some years ESG lagged due to less exposure to oil, but over 5 years, the AI-driven ESG portfolio slightly outperformed with lower volatility. The takeaway? Strong ESG companies are often better managed and more resilient. AI can cut through the noise and build smarter, more ethical portfolios. You don't have to choose between values and returns. The future of investing is both green and smart. Want to stay ahead of the market in minutes? Our AI-powered daily briefing pulls the top headlines, real-time prices, and on-chain crypto data, then synthesizes it into a concise 3-minute video. It connects the dots, explaining why Bitcoin is moving, or what's driving S&P futures. AI generates the script, voiceover, and visuals, delivering a professional, data-rich update in 15 minutes. No more sifting through noise, just actionable insights, fast. It's the smartest way to start your trading day. Let AI do the heavy lifting so you can focus on decisions. So who wins, humans or machines? The data is clear. For most investors, low-cost automated strategies have outperformed